Banks spent 15 years calling Bitcoin a scam, and now they're scrambling to buy as much of it as they can. The irony? It gets so much worse. Imagine you're a banker in 2013. Some internet nerds are talking about digital money that lives on computers, no government backing it, no central authority, just code and chaos. You laugh it off. Fast forward to today, those same bankers are in boardrooms sweating over Bitcoin strategies like their careers depend on it, because they do. Even the guys who called it rat poison are now quietly asking a different question. How do we profit from this without losing control? The mainstream narrative sounds polite. Banks are exploring blockchain technology. They're considering digital asset integration. It sounds voluntary, it sounds innovative, but here's what they're not telling you. They don't have a choice. This isn't exploration, this is survival. Because while banks were busy dismissing Bitcoin, something shifted underneath them so dramatically that ignoring it became financial suicide. Because here's the part Jamie Dimon won't say out loud. Bitcoin crossed a threshold banks can't uncross: institutional legitimacy. When BlackRock, the world's largest asset manager controlling over $10 trillion, filed for a Bitcoin ETF, that wasn't just news, that was a declaration of war on the old system. Suddenly, pension funds, sovereign wealth funds, and billionaires who wouldn't touch crypto with a 10-foot pole started asking their banks, "Why don't you offer Bitcoin services?" And banks realized they had two options: adapt or watch trillions in assets walk out the door to competitors who did. This wasn't greed driving them toward Bitcoin, it was fear, the fear of becoming irrelevant. It's like watching someone who spent years mocking electric cars suddenly panic buying a Tesla dealership. But the pressure didn't just come from customers, it came from somewhere way more dangerous. Regulations started catching up. Governments worldwide began creating frameworks for digital assets. Switzerland, Singapore, the UAE, they rolled out red carpets for crypto banks. And then the US started making moves. The SEC, despite its chaos and lawsuits, began approving Bitcoin ETFs. That approval wasn't just bureaucratic paperwork. It was the government saying, Bitcoin is real and it's not going anywhere. For traditional banks, this created a nightmare scenario. If they didn't offer crypto services, they'd lose clients to crypto-native banks that did. If they did offer crypto services without proper infrastructure, they'd get destroyed by regulations or hacks. They were stuck between extinction and execution. And the cherry on top? Central banks started developing their own digital currencies, CBDCs. Governments looked at Bitcoin's technology and said, "We want that control." Banks realized they were about to get squeezed from both sides, decentralized crypto eating their lunch and government digital currencies eating their dinner. This is when the dominoes started falling fast. JP Morgan, the bank whose CEO called Bitcoin a fraud, launched blockchain payment systems. Goldman Sachs reopened its crypto trading desk. Bank of America filed dozens of blockchain patents. Deutsche Bank started offering crypto custody. Even small regional banks started partnering with crypto platforms just to stay competitive. The walls came down so fast, it was almost comical. If financial hypocrisy could be measured in dollars, we'd be talking generational wealth levels of contradiction. These weren't gradual shifts, these were panic pivots. But here's the part that changes everything about your financial future. Banks embracing Bitcoin doesn't mean they're giving up control. It means they're trying to capture it. Think about it. When banks offer Bitcoin custody, they're becoming the middleman again. When they create ETFs, they're packaging Bitcoin into the same old financial products. They're not adopting Bitcoin's philosophy of decentralization and freedom. They're absorbing it into the system Bitcoin was designed to escape. This matters to you because the next decade will determine whether Bitcoin stays a tool for financial independence or becomes just another asset banks control. Every time you choose to hold Bitcoin on an exchange instead of in your own wallet, you're voting for the old system.
Every time institutions buy Bitcoin, they're diluting the revolutionary potential. And here's the kicker. Your banking fees, your loan rates, your access to financial services, they're all going to be reshaped by how banks integrate crypto. If they control it, you'll pay for it. If they can't control it, they'll restrict it. Banks can't ignore Bitcoin anymore because Bitcoin stopped being a fringe experiment and became a systemic threat. Not a threat to money, a threat to their monopoly on money. And when trillion-dollar institutions feel threatened, they don't fight back with arguments. They fight back with adoption, regulation, and control. The lesson here isn't about Bitcoin winning or losing. It's about understanding that every financial revolution gets absorbed by the system it tried to replace unless people actively resist that absorption. Finance has always been about power, dressed up as convenience. Banks joining the Bitcoin party isn't validation, it's infiltration. And the wildest part? Most people celebrating institutional adoption don't realize they're watching the very thing Bitcoin was designed to prevent. The question isn't whether banks will ignore Bitcoin. They can't. The question is whether Bitcoin will survive banks not ignoring it. And if you think this story is wild, wait until you hear about the hidden war happening right now between governments and Bitcoin miners. That's next.